and it's decision day here in Nigeria. The CBN MPC have been meeting since yesterday. Today, we would hear their decision, and here on Channels Television, we'll bring it to you live. Welcome to the program. I'm Ini John Mekwa. It's a special Business Incorporated today, but it's still 55 minutes, more than 55 minutes of business. And of course, on this program today, we'll look at the MPC and their meetings, their considerations since yesterday, and what they would decide to do with lending rates as well as other rates today. Welcome to the program. I'm Ini John Mekwa. Well, just to refresh your mind a bit, last meeting, the Monetary Policy Committee meeting of the Central Bank of Nigeria was in November 25th and 26th, 2024, and the committee decided to increase the monetary rate by 25 basis points to 27.50, a smaller increase than expected by the market. By then, reasons for that was the rising inflationary pressures, including food, core, and headline inflation. Of course, we did see the inflation tapered in December. There was also increased fuel prices. That has also changed. And then CBN's confidence that economic growth will continue to recover in the third quarter. Other decisions. Also, the asymmetric corridor around the NPR was plus 500, minus 100 basis points. They retained the cash reserve ratio, deposit money banks at 50% and merchant banks is 16%, as well as retaining the liquidity ratio at 30%. So we'll see which of these will change today. But before we get to that, let's also give you a bit of what's happening in other scenarios. We do global. In spite of the MPC meeting, we can tell you that oil prices were a little changed on Thursday after rising to a near one-week high in the previous session, as industry report shows a build-up in the United States crude stockpiles, and that has pressured market. And so we see a drop in some of them. For instance, in Brent, we see it's now up to $76. It gains 0.11%, while for WTI, it's in the red, 0.06% at $72.21. And so we saw that build up in the United States crude stockpile. That, of course, will pressure prices, and prices edge lower because of that stockpile. And then Russia and Caspian Pipeline Consortium oil flows, which is a major route for crude export from Kazakhstan, were reduced by 30 to 40% on Tuesday after a Ukrainian drone attack on a pumping station right there. So see why the peace talks is important and a major mover of oil prices. A 30% cut is equated to be at about 380,000 barrels per day of the market supply. So if this is sustained, of course, we will see an increase in oil prices globally. From oil to metals, gold prices held firm near a record high on Thursday as United States President Donald Trump's tariff plans stoked fears of higher inflation and a major global trade war. Look at the numbers for this afternoon. Well, it's a flip from what we had about this time yesterday. Remember, yesterday about this time, we had more of the red. So spot gold is up 0.2% at $2,937.74. U.S. gold is also up $2,955.90. Spot silver up 0.1% at $32.75. Platinum is unchanged, and palladium is just a little bit changed, 0.1% at $968.94 for an ounce. And then to Nigeria now, money supply, as broad money supply surged, that's the M3, surged to 110.98 trillion naira in January, reflecting a 17.3% year-on-year increase from 94.61 trillion in January 2024. According to data from the Central Bank of Nigeria's Monetary and Credit Statistics, the rise is largely attributed to an increase in both net foreign assets and net domestic assets, signaling a growing liquidity trend in the economy. These figures come ahead of the meeting. We're expecting the decision today where the country's interest rate will be reviewed amid concerns over rising inflation. Well, new inflation numbers shows a tapering one, and the uptick in money supply is expected to influence discussions on strategies to manage inflation and stabilize the naira. Additionally, Nigeria's net foreign assets rose 35.39 trillion in January, marking a 19% increase from 29.73 trillion in January 2024. Still staying with the CBN, the number of dormant bank accounts in Nigeria is over 19.6 million. That's according to Industry Customer Account Database released by the Nigeria Interbank Settlement System, NIPS. The data, which tracks monthly account status throughout 2024, indicates a steady rise in inactive accounts, coinciding with new regulatory measures by the Central Bank of Nigeria requiring commercial banks to publish details of dormant accounts. The CBN directive, issued to enhance transparency and return on claimed funds to rightful owners, come amid concerns that a significant number of accounts have remained idle for extended periods. According to NIPS, dormant accounts remain above 19 million every month since February 2024, with December closing at 19.697 inactive accounts. And there was an auction yesterday, an NTB Treasury bill auction, and it does seem like the bull run may be coming to an end as yield on the one-year bill or bill auction fell to its lowest seen in a year at the primary market. At the auction on Wednesday, yield dropped to 22.58% from 25.49% as investors priced in new inflation figures. The current yield is the lowest yield since the beginning of hawkish policy stance by the Monetary Policy Committee that led to 850 basis points hike in interest rates. Well, market analysts say that this is driven by a cautious outlook on inflation, considering the significant decline in inflation, which we've seen now at 24.48% from 34.8% in December, as well as prevailing market sentiment. By November, it had peaked at 30.7% before gradually declining to current levels. Similarly, yields on OMO bills have also declined, dropping by 300 basis points. That was experienced at the last auction, and analysts said that this signals potential rate cuts at the MPC, and we'll see if analysts are correct in a couple of hours. Leaving the market just for a bit, speaking on the posture and preparedness of Nigeria to respond to the ongoing global trade politics and trade war, the Nigerian ambassador to the World Trade Organization and recently appointed as the chairperson of the Council for Trade and Services Special Session, World Trade Organization Ambassador Adamu Abdullah Hamid has said that Nigeria should be focusing on digital trade and redirecting trading into services rather than goods. Also speaking to the positioning of Nigeria in the World Trade Organization, Ambassador Abdul Hamid said that Nigeria is recognized globally as a leader in the multilateral trading system.
The preparation for Nigeria should be in the area of services. The services is what, of course, the global community, various countries in the world are redirecting their trading into services. Because services, if you look at the classification of in services, it touches in various areas. Okay, now Nigeria should be prepared, and of course they are also doing well in the area of digital trade. So that should be the focus. That should be the area that we should put more of our emphasis toward, so that we can take advantage of the current global realities and of course the future realities in terms of trade. Fortunately to Nigeria, we have the leadership of the organization, and of course we also have now the leadership in spearheading the negotiations on trade in services. So by implication, it means Nigeria is recognized globally as a leader in the multilateral trading system. And therefore, we will do everything possible to ensure that Nigeria is benefiting
Right.
more and more in the area of international trade.
All right, let's stay outside the MPC just for a bit more. We're going to Europe, where some countries are reluctant to implement the new EU rules on sustainability for years now. Companies have been working hard to switch to alternative energies to fulfill climate goals, but they also have to keep in mind social policies. But some are worried about what it all does to business and the economy. Lars Holter joins us now to give us the details of this. Hi, Lars. Good afternoon. Well, we are talking sustainability again.
Yes, hi, Ini. It is with us, this topic, all the time. Sustainability, corporate responsibility, it's all good and well. And I'm glad we're talking about it that often because it is just so important. But it does cost money. And that is really the problem right now. Looking at Brussels, we're talking about the Corporate Sustainability Reporting Directive, or for short, it's called the CSRD. And it's a big topic for the last couple of months, but especially now in the last couple of days, it's popped up again. It sent shockwaves to the corporate world over the last couple of years already, because here's why. The directive is a set of rules that tell companies how to file their annual reports on sustainability, how to report the measures that they have undertaken and what their effect was. Now, we're looking at some environmental goals here, of course, many regarding air and water purity, CO2 emissions, all very straightforward. But then there's also tons of rules regarding the protection of indigenous people. There's social inclusion of minorities, the protection of corporate whistleblowers, and so on. Now, all of these points, I'm sure you agree there too, are valid. Of course, a company wants to make sure, and they should ensure, that the rights of indigenous people, for example, are not abused within their supply chain, or they're let's say, not working with resources that have been mined by oppressed people or by children. So any way you look at it, this entire idea of sustainability in environmental and social terms is so important, and it is good. But like I said, it costs a ton of money, and many say the cost at this point on an EU level far outweighs the benefits.
So it will be interesting, Lars, to know what exactly is this cost that we're talking about. You said a ton of money.
Yeah, it's actually really hard to come by EU-wide numbers, but I got some numbers for you here just for Germany, and they are already quite shocking. Fulfilling this directive on the EU level that I just mentioned is estimated to cost around 1.6 billion euros, and that is not, Ini, for the measures taken by companies to achieve these very important goals. No, this 1.6 billion, that is the cost of reporting these efforts correctly. So we're talking about a giant bureaucracy that needs to be fed. We're talking about teams of experts in companies that take months to prepare these reports the EU is asking for. And why is it so expensive? Because the directive is so detailed and so complicated. We're talking about rules over 66 pages. We're talking about 300 pages of complementary provisions and 1,200 criteria that should be considered. That is according to a list that was published by the European Financial Reporting Advisory Group. So there is just a vast amount of rules and details, and they need to be followed by to a T here by all companies. They need to be audited, and in the current economic environment, some are worried about what effect this will have. France just now has actually urged the EU to modify the CSRD and to postpone its application.
It does sound complicated, even just listing them out, Lars. But let's take a breather from that and head to the market. What are investors doing intraday?
Well, we saw some profit taking late in yesterday's session. So coming out from that, today, the big question is, of course, will this be the beginning of a turnaround? We've seen signs of that in the last couple of days. It doesn't maybe yet look like it. Markets seem pretty stable today. We did hear from the ECB, however, that there might be an end in sight to cutting interest rates. That is certainly putting a little bit of pressure on markets. We're seeing shares of Mercedes-Benz down after the car maker came out with lower profits than was expected. And on the flip side, we're seeing a very strong performance by Airbus with shares selling off a bit anyway. So there's quite a few stories out there, but mainly, of course, Ini, everyone knows that what will really have an impact on markets in future is the election we're heading into now this Sunday. So let's see how today and tomorrow goes in terms of trading and then what the election will bring.
Yeah, election, big one right there at last. And I know we'll get the full gist by Monday. But thank you so much for updates this afternoon.
You're welcome. Thank you, Ini.
All right, now coming back home and our big story for today, which is CBN's MPC's decision. They've been meeting since yesterday, and we expect decision announcements at about 2 p.m. So stay right here with us to know how much it will cost you to borrow money, among other rates. That's what we'll be bringing to you. But for now, let's look at other parts of the continent, major economies in Africa, and see their status at this time. Ladi, I believe, has the gist of that at this time.
It's
Ladi.
the real gist, though, because this is the first one in Nigeria, the first MPC meeting for 2025.
That is just February. It's just February.
Exactly.
Yeah,
and, you know, this one is a big deal for
it's
everyone.
a big deal because of the rebased numbers.
Exactly. How is that going to, you know, drive sentiment with the MPC?
Yes,
you know, at this point?
Especially because there's the notion and questions being asked as to do this new numbers, or does this new number actually reflects the reality? So if the MPC makes a decision based on this number, will it really be capturing the reality, or will it just be the numbers, you know, that they're making a decision on?
And I guess that's why consensus, you know, is a hold, you know, at this point, because I guess they'll need more time to really understand, you know, this rebased data. It's the first one, you know, we've gotten for January. They might have to look at maybe February, March, and maybe more months to be able to make, you know, accurate decisions at this point. But let's get a picture of what's before this MPC right now. Starting with Nigeria, let's see the data there. We know inflation for January, that came out. That's the rebased numbers. That's 24.48%. If we start with Nigeria for the continent now, that's for the African continent, we see Nigeria 24.48%. That's inflation number, and we also have our lending rate about 27%. So at this point, it seems like the MPC might have to chase, you know, inflation numbers, since inflation number is now below the monetary policy rate at this point. So that was for Nigeria. Let's look at what's playing out in South Africa. South Africa's central bank, they lowered their borrowing costs for a third straight meeting, while warning that risk to the inflation outlook that has increased for the last meeting. So the 6-member Monetary Policy Committee reduced its benchmark rate by about 25 basis points, and the repo rate 7.5%. And we see inflation stayed steady right there in South Africa. The repo rate 7.50%. Next MPC meeting, that's not been announced yet, just yet. Inflation, that's 3%. That's the last one for, that was in December. So markets are still anticipating the inflation numbers for January. That's for South Africa. Then we see in Ghana, Bank of Ghana kept its main interest rate at 27% in a decision that was announced in January by the Monetary Policy Committee. The country they're seeking to boost economic growth amidst a tight consumption price index there. So there you have it, 27% unchanged for the lending rate. Inflation, that slowed in January to 23.5%. The next meeting for Ghana, that's March 25th to 28th. So that was the first decrease for inflation in about 5 months, but it's still above the Bank of Ghana's target range. All right, let's take it on to East Africa. Now, that's Kenya. As of February 17th, 2025, the lending rate in Kenya, that was 16.89%. The interest rates, that's what's charged by most of the banks, therefore, short and medium-term loans. In January 2025, Kenya's inflation rate was 3.3%, which was higher than the 3.0% recorded in December 2024. The increase was due to rising prices in food and transport sectors. Then on to Angola now. Angola Central Bank, they left their main interest rate unchanged last month. That's for the 4th time in a row as inflation continued to ease. That's in the oil-rich Southern African country, but remains above the 27% in annual terms. So we see it right there for Angola. Lending rate chain at 20.5%. Inflation, that dropped in January to 26.48%. And the next MPC meeting, that's coming up March the 18th. So definitely a lot to unpack there with most of these African economies. And I guess, 2024, it was all about, trying to tame inflation, even though some economies had it in the bag with inflation numbers, coming to their targets. We saw that in the US and the UK. But come 2025, it's looking like a different story right there with the first hold from the US Fed, and now they're anticipating Trump tariffs might actually stoke inflation
China
in 2025.
China too has held
and China,
South Africa cuts.
Exactly.
So I mean, it's a mixed bag. I guess you just look at your parameters and make your decision based on it.
Right, but for here, it's rebased numbers we're looking at.
Yeah, we'll look at it close.
Very closely.
All right, Laddie, thank you so much.
You.
All right, so that is supposed to lead us into the conversation, awaiting the decision by the MPC. They started the meeting yesterday, and we're waiting for a decision today. We expect that at about 2 p.m. So before that, perhaps we should preempt what they are discussing at this time. But let's take a break now. When we come back, we'll have our guests who will try to, preempt what the MPC is discussing at this time and what possible decisions that they could come out with. That's after this break. Do stay with us. It's a special edition of Business Incorporated. That's right. It's decision day here in Nigeria. The meeting that started yesterday by the Monetary Policy Committee of the Central Bank of Nigeria will share their decision today. And we are working along with them on that. I'm sure they're all seated now, perhaps, or still having some last-minute conversations behind the room where we would see that or get that announcement from. But just before they come out, let's see if we can read into their minds, and perhaps the little fly that has been with them since yesterday will give us a bit of what they've been talking about. And to do that, right here in the studio is the partner and head of transfer pricing services practice at Anderson, Nigeria, Dr. Josh Bamford, as well as Mr. Hakeem Mohammed, the Executive Director, Global Markets and Institutional Banking, FSD Merchant Bank. Gentlemen, good afternoon and welcome to the program.
Good afternoon.
Okay, so I don't know how excited you were. I'll start with Dr. Bamford since you're close to me here. How excited you were or anticipatory you were for the rebased number, because we know that is supposed to be at the foundation of every conversation that the MPC would have and the decision they will come out with. And then we saw that 10.3% slash in the in the data. Yeah. Did you see that coming? And what are just your thoughts around that?
All right. Clearly, we all either excited. I would think most people should be excited about the fact that the inflation rate has reduced significantly when you compare it to December 2024, where we're around 34.8, and now all of a sudden we're around 24.48. That's a significant decrease, more due to the rebasing effect itself. I think the excitement more has to do with what is going to be the response from the Monetary Policy Committee based on this new information. Because prior to that, when you listen to analysts, the whole argument was it was either going to be a marginal increase in the monetary policy rate to, let's say, 27.75, let's say 25 basis points, or a hold, all right? Now, I think the conversation is more of a hold or a slight decrease, right? Because there's some wiggle room that they can play with in terms of attaining price stability, which is the core mandate of the Central Bank of Nigeria. So I'm really excited, and I really would want to see whether the Monetary Policy Committee will pivot from their hawkish stance that they've had throughout 2024, which I sometimes disagreed because I have always been of the opinion that there are three key markets, right? There's a forex market, there's the market for funds where the price is interest rate, and the market for goods and services. And if we can attain forex stability in terms of the exchange rate, I think we can have a bigger impact in terms of price stabilization compared to the consistent hike in monetary policy rate, which was getting to some levels which I thought was unsustainable for business. So I'm hoping he can take a pivot and decide to even surprise us by reducing it, but most likely it's going to be a hold.
Okay, all right. Mr. Mohammed, are you excited too, like Dr. Bamfo?
Yes, absolutely. I mean, if you look at what has happened, this current central bank, they are quite. The central bank governor is very clear. It's quite hawkish, because he believes, and with good reasons, right? If you think about what has happened since the administration of President Tinubu came into office, it took some bold steps around, removal of fuel subsidy, unification of rates. Then also, maybe you can also add to that, also some of the things that they did around increasing the electricity tariff. All of that have inflationary impact.
Or rather, removal of subsidy on electricity.
Yeah, well, absolutely. So all of that have impact on inflation, right? And so it's not surprising to see what they've done, since I think since early last year when they started to increase MPR, because they thought it was important to tighten, and also the currency came under pressure as a result of all of these actions that they took. So I'm not very surprised by what they've done. Yeah, maybe the scale was maybe a bit too much. One could argue, but I think generally speaking, it was what was needed to be able to stabilize things, and we're already seeing that happening in the market. So, for example, the exchange rate has been very stable since last year. This year, for example, if I just today, we've actually seen like harmonization where the official exchange rate and the rates on the streets have actually converged, which was what happened when they started some of these things initially, but we saw it sort of move away. But now it's good to see that it sort of come back. And like you said, I also expect that at today's meeting, the general expectation is that there will be a hold, but I think they might tweak the corridor just to ensure that some of what we're already seeing is also feeding into the system, because it's one thing to come to an MPC meeting and make an announcement, but what's more important really from my own perspective is that it needs to be transmitted well into what everyday people will see. Because some of what has happened now, we were speaking earlier on, the real sector, people who do everyday things, the manufacturers, the SMEs, they're borrowing at very high levels. So the question is, for how long will they be able to sustain this? And I'm hoping that the MPC members are also looking at this. These committee members are looking at all of this, and they're considering what is good for the overall economy.
But if the MPC will base its decision on these rebased numbers, which at this moment is somehow being criticized, as per how realistic is it? The new methodology, the reduction in the weight given to food, for instance, and all of that. So if they would base it on this number, and people are asking about how realistic the numbers really are, then don't you think that perhaps we may be going ahead of ourselves if there's a hold or a cut?
Okay, well, I mean, let's think about it this way. The last time the rebasing was done was in 2009, so 15 years ago. We all know that our consumption patterns have changed. We're buying new stores and all. So I think, actually, the standard is to do it every 5 years. But we haven't done it, in like 15 years. So I don't think, we could, we can argue whether what they've done, how they reduce the weighting of food, for example, is okay, or it's probably too much. But again, you have to also remember that what the MBS has done, it was done in partnership with credible agencies. The World Bank was one of the World Bank, IMF, and the Central Bank. We worked with them to be able to achieve this. Now, I know that, on the face of it, people will be like, oh, if I go to the market today, I'm still buying at this level, right? That may be true. But what they've done is, I think over time, is going to give a better indication as to how prices are actually moving. Yes, it went down by 10%, which seems very huge, and that's why I think a lot of people are criticizing it. But I think it's just a natural sequence of events. And just to give maybe to delve a bit more into it, the process didn't just start, this year. They conducted a survey in 2023, cost of living survey, and they saw from that survey that, the consumption pattern has changed. People are buying different stuffs now. And I think, it's something that is important that they've done. It may look a bit, do you trust them or not? But I think we should give it some time. We should see, this can only happen this month, for example. By next month, we'll start to question, okay, it dropped 10% last month. What then happens this month? I think it's something that, what I would have loved to see is them maybe publishing what it would have been if it wasn't rebased or
with
something,
just to compare. Method.
Just to compare. But again, it doesn't really matter if they didn't do that. But I think what's more important is that we have something that is now maybe more reflective of our current situation. Because again, if you think about it, in 2023, when the currency moved from 460 to 750, or and closed the year around 1,000 or so, that was a big move, right? They need to find a way to reflect some of those, and that's really what has led to all of this. Last year, inflation was stubbornly high. You mentioned
which is why, Dr. Banfo, a lot of people are saying it looks too intentional that the base year is 2024. We know what inflation was like last year. So when you use that as the base year, obviously you're going to have a huge drop.
Yeah. So for me, I think we shouldn't be too concerned about the drop. Yes, tell me. It's just, it's a rebase. So we start a new base. What matters is the trend.
Yeah.
Where we go from here. All right? Because if they had not done the rebasing, they were expecting inflation to have kind of slowed down to around 34.2 from 34.8. All right, now you've done a rebasing based on changes in consumption patterns, taste, and preferences, which is reasonable because it's expected that they do change. After 15 years, there's a strong basis for you to do the rebasing. The question is now that you've started on a new slate, 24.48 or whatever it is, what is going to be the inflation rate come next month when you compare it to the same basket for last year?
Correct.
And what's going to be, so if you don't have the right policies, it's still going to show up. Very soon it start trending back up. And we tell that, you'll be exposed. So that's the reason why the decision is going to be big. It's going to be big in the sense that if the Monetary Policy Committee are aware of the methodology and they know that, look, we don't have the means to actually continue to have a downward trend, then they're going to hold, or, then they're going to hold because they know that, look, we really don't have the ability to guarantee a downward trend. Our expectation, if we want to have real price stability, for developing countries like Nigeria, is 9% plus or minus 2%. So that means your target should be between 7 to 11%. Being at 24.4 doesn't mean you're out of the woods. You're still far off. So there's a lot of work to be done. So for me, number one thing is going to be how they continue to stabilize the foreign exchange market. We all know the foreign exchange volatility was the biggest contributor to inflation going up. When the government took over, inflation rate was around 22%. That was May 2023. Then you go to 38.4. It tells you mainly because of those two reforms, fuel subsidy removal and the floating of the exchange rate regime. Now, having floated and having bridged the gap between power market and the official market, how do you stabilize the exchange rate? Once you stabilize that, you know that there's no way our imported fuel, refined fuel, is going to cost as much. Prices at the fuel pumps are going to be more reasonable. Transportation cost of food is going to be more reasonable. When we can stabilize those stuff, right, our inflation will stabilize. And then we can then invest in the real economy by bringing interest rates down. Cost of borrowing becomes cheaper. We start making investment, create job opportunities for the teeming masses that are struggling. We really need to be going back to growing around 5% or more. This 3.46 that we are growing and we are happy about it, that's a mediocrity. You understand me? So for me, there's an opportunity to pivot, to focus on the real economy because you have a wiggle room and ensuring that the trend is downward. If it starts going back upward, then really the rebasing did not help us.
Okay, so I've heard both of you talk about stability in the FX, and you seem to believe that we have gotten to a level, or we have gotten to stability when we talk about the value of the naira and all of that. But I've also had a conversation with someone who said, perhaps we are in the corridor of stability, but we are not stable yet. So are we really in stability space or in the corridor of stability when we talk about the naira?
All right, let me start then. I would like Michael, because we talked about it earlier on. So first and foremost, I think we have an opportunity to have a pretty stable forex market. And I have to give the Central Bank of Nigeria a lot of kudos, because what they've done in terms of bringing efficiency, in terms of supply of forex into the foreign exchange market is phenomenal, right? Now, when remittances come, they are going to come through the official channels for the most part. So there's some significant supply of forex into the market. On the demand side, there's more transparency. The more transparent those transactions are, the more you understand the sources of demand, so that you can take out speculative demand, which creates distortions. So they've created some enabling environment within the market that can achieve the stability we are talking about. Now, based on some work that has been done by some economists, there's an expectation that the real value, or the value of the naira, should be around 1,100, using a concept called the purchasing power parity. All right. So even at 1,500, we can still do more in terms of actually appreciating the naira, but it has to be gradual. You don't want a situation where you don't succeed and it starts going back up, then speculators come in, buy so much, then the depreciation moves faster. So there's an opportunity for us to have a stable naira. For me, around 1,400 or even 1,300 over time. But if we achieve that, then what is going to happen is that there'll be a positive rippling effect across the economy, because businesses can plan when they have a stable, forex. The foreign direct investors that left the shores of this country might rethink about coming back, the Diageos of the world, the Procter & Gamble's of the world, who couldn't plan because of that instability and high cost of borrowing. We need to create an enabling environment for both foreign direct investment and domestic direct investment, such that this country starts running on its own. And I think it's achievable.
Are we stable yet, or we are just in the corridor?
So I think, before I answer the direct question that I asked, I think one of the things that this central bank has done, and has done very well, really, is to improve the confidence in Nigerian FX market. A few years ago, we struggled to attract even $100,000. This year, for example, 2025, we've seen roughly $2.6 billion come into the system, and these are from portfolio investors who have found the Nigerian yields attractive, and this is what I expect that they are going to continue to do. Now, when you say whether we've achieved stability or not, I think we are around the corridor of stability. Let's say.
Okay, so
right?
you joined the corridor now.
Yeah, let's say, because and that's because earlier in the year, late last year, the currency went as high as 1,700.
Yes.
And we've seen it. For example, since the beginning of this year, it sort of traded around 1460 to maybe 1540 sort of range, which I think is not bad. And we've seen, and we continue to see flows. Now, one of the things that the MPC will be considering that they are meeting today, really is around, okay, what should they do? How quickly should they move rates in order to ensure that people are not, especially the portfolio investors, are not taking profit and exiting? Because if they don't time that profit taking very correctly, then we probably may lose all of the gains that we've seen very quickly. And I think the central bank has also done a few things around trying to improve price discovery, transparency. They introduced, for example, the B-match system early December. And what that does is that it allows every player in the market to see where, what are the volumes that have come into the market, what are those prices. So there's a lot of transparency, and price discovery is a lot better than than what we had before, where if you wanted to buy dollars, you need to look for somebody who has it, and that guy then decides what rate he's going to sell at.
I think for me the biggest shocker is when we see the gap between the parallel and the official market close. And yesterday there was a huge drop in the parallel market. We don't know if it's going to be sustainable, but at least we saw that. Which, I mean, as you said, it was really difficult to even see the rates of what was going on or what was driving rates. Now we do know when the CBN intervenes, we know what to expect and all of that. And it's been going on for about, I think, 3 months now, sustainably. So, but I would like to know the fair value of the Naira, because, I mean, I know Dr. Bafo said, okay, we are comfortable around 1,005, but honestly, I was praying for less than 1,000. That was my prayer from late last month. I don't know if God has not answered it. But first of all, I would like to show you visuals of the CBN headquarters where that announcement will be coming in a couple of minutes. There you have it. So it does look like members of the MPC are still indoors, maybe having last-minute conversations and a decision that they would like to announce. Maybe because the inflation numbers came up, just a couple of days ago, so they don't have they've not had a lot of time to consider. But this is where the CBN governor would lead the MPC members, committee members, to tell us the rates for the next 2 months or so. It's empty now, but I will keep our eyes there. And of course, immediately members start coming in or the CBN governor comes out, we would obviously just switch there to give you the live decision. Meanwhile, while we wait, we're here. So, gentlemen, I would like to know from your perspective, your findings, what could be the fair value of Naira? I know that 1,005 is the target of the federal government, you understand, but what do you think would be the fair value of the Naira at this rate?
Okay. So there are a number of factors that would determine what will be the fair value of what is the actual market rate for the Naira in terms of the dollar. But I think, if it's true that the central bank sees 1,500 as their comfort zone where they can actually manage the rate, my view is that I think the Naira is actually undervalued. I think we can go, Naira can appreciate a little bit more than where we are now. But I think strategically, they might be skeptical about Russian, because right now we don't, initially Cardoso has used the willing buyer, willing seller. Lately, you can't continue to use that because it's not a willing buyer, willing seller. It's a float managed, market.
Managed floating.
Yeah, managed float, because they will determine what price they will sell to the selected banks. They've given the bank some particular margin they need to add. They've told BDCs how much you can add. So you are managing the market, so there's some intervention in that market. But they've not fixed it like the way, it used to be based on the prior administration. So they have the ability to decide, at what rate they can continue to manage it well. And if they have the data and they believe that, look, based on a number of factors that can help us continue to manage it, we can actually push it further down to, let's say, 1,003. I think they have the ability to do it. Look at the external reserves. It's about 40 billion, which is one of the highest we've had in recent times. That can help you support whatever appreciation you want. Look at production of oil. It's on the ascendancy. It was 1.48, thereabout. Look at the amount of oil production, refinery being done locally by Dangote. That means that you're not going to have that pressure on the demand for forex in order to import as much, refined oil as you used to. So there are factors that is playing into the advantage if they really want to maintain the strength of the Naira to about 1,300. It's all up to them what they want to do. Now, the difference between managing MPR and the foreign exchange market is with the MPR you have full control. All you have to do is determine at what price I'm selling to the banks, overnight loan. But here, the other factors that you don't have control over, so you're a bit more skeptical in terms of where you want to get to. And so I understand doing this gradual management of the Naira, but I think there's still room for appreciation of the Naira to something that is sustainable going in the long term. As long as you take away significant chunk of speculative demand, which you would do as long as speculators cannot anticipate the price going back up, right? Why would I buy so much when I don't expect it to go up? You understand? You take out speculative demand. Then the rate you see becomes more sustainable. But if you're not able to sustain it, and then you have some volatility, then speculators are going to come in and play their games. and they're going to demand so much, not for real purpose, but just to hold until it goes up, and then they sell. Then there's distortion, then that becomes problematic. That's what we're facing. So I think there's still room for us to have the Naira appreciate, because the factors are in the favor of Central Bank of Nigeria.
You see appreciation, Mr. Mohammed?
Yes, absolutely. I do see appreciation. And think about it this way. I mean, what determines the exchange rate is essentially demand and supply of Naira. So it's Naira being demanded from offshore. So today, for example, we are demanding foreign currency. So meaning we have to exchange our Naira for the foreign currency. So how many people, from offshore are demanding Naira because they want to buy from Nigeria, right? But to the extent that we still have that gap today is why, there's maybe constantly pressure.
So that means, you're trying to see if we can increase our exports.
Absolutely.
That's one way of increasing demand for Naira.
Yes. And also, you spoke about, the Dangote refinery. Before that refinery came on board, we're importing all of our PMS. Now, a bit of that is, even though I know that there's a bit of back and forth between Dangote and some of the importers, right? But my point is, a bit of that is being served locally. And that on its own is reducing the demand for foreign exchange. And those, for me, are the things that will then go into the value of the currency. Now, you have, so currency is currently at 1.5. You spoke earlier on that rates are coming down and on the parallel markets. We actually saw a convergence today, right? In fact, and I won't be surprised if over the next few days or something, we actually see the parallel market rate go below the official rate. Now, but that's not to say, and all of this is being driven by supply, because there's supply on the market. Then people are a lot more confident about what is happening in the official market. Because one of the reasons why people who have legitimate demand actually would go to the parallel market to go buy FX is because they're not sure they will find. If I come back tomorrow, will I find? And because of what has happened maybe in the last 2 years, where we've always struggled to find maybe liquidity. It disappears, sometimes it comes back and all. So a number of companies who are legitimate buyers, who ordinarily would be buying from the official market, started buying up dollars to stock inventory. Now, that is costing them a lot of money. But if they know that when it's time to buy the FX to import whatever it is they need to import, FX will be available in the markets, then they won't have that, there won't be that urge. So we've seen all of that sort of come down. So what you're seeing now are legitimate demand. Speculative demand, is really out of the door, because really, if you speculated and bought at 1.6, now the currency is at 1.5. You've lost 100 naira already. So all of that, and that's where, earlier on I said confidence is returning to the market. And once people know that when it's time for me to buy, I can go into the market and buy, then all of that speculative demand would reduce, if not disappear. Now, so that's one. But to go specifically to your question, you're asking whether what do I think is the real value of the currency. Again, it's difficult to say. 1.5 is where, obviously, and even the budget of 2025 was done on the basis of 1.5. So the government, central bank, in a way, have their eyes on it. But that's not to say that if there is really huge supply into the market, that the currency will not go below. I mean, we've seen instances where, at least even this year, sometime in January, where the currency went as low as 1.460. There were some buying up again, it went back up to 1.5. I think we'll be seeing all of that, and that's the good thing with the system that we have running now. It's strictly on the basis of demand and supply. You have people exporters who are exporting, have received export proceeds and need Naira to settle their obligations. If they go into the market, they want to sell at 1.600, for example, but they can't find anyone to buy at 1.6. So they'll be forced to sell at whatever the market is. And that's one of the things that BMatch has done, because those prices are there. Everyone will see it on the screen. You know where the market is. So gone are the days maybe when you're asking and someone is quoting you, you speak to 3 different banks and you're getting 3 different rates. Now you're going to be getting rates somewhat around the same sort of area. Clearly, there's going to be marginal differences, but it's not going to be anything substantial. So I think we might see the currency around maybe 1.4, 1.5 is where I see it now. Now, depending on what we then see on the supply side, whether we are seeing more FDIs, continuous FPI interest, but the MPC needs to be careful regarding how quickly they cut, because you also don't want FPIs at this stage, to start to take profits. Because when they start to do that, you are going to see pressure on the currency, and all of these gains that we're talking about now will just disappear.
So people have said that including the BDCs officially into the market would also help. We've seen the CBN, give supply officially to the BDCs, but what do we lose by actually putting them into the official structure, of our FX?
So they're actually in the official structure. I mean, the central bank issued a circular. I think maybe in the last few days, they actually extended the deadline. So BDCs are allowed to buy from banks today.
Yeah, but that's increasing the chain. So when they go to banks and buy before it gets to the retailers, you get what I mean? But if they're officially there, I know the CBN has announced a couple of times how they're giving direct supply to them. But when you increase the chain that way, I mean...
Well, I mean, one could argue, right? BDCs are actually, cater for the retail. And the central bank really shouldn't get involved in, going to the very, very last man, right? If you understand what I mean. To the extent that these BDCs are customers of the banks, and the banks do have ability and access to liquidity to be able to supply them. I mean, what the BDCs are serving folks who are traveling, who want personal travel allowance, business travel allowance, people who want to pay school fees, medical fees, etc. Some of those, a lot of that demand is not a lot. It's something that easily, I mean, we've gotten used to central banks supplying BDCs is why, this thing keeps coming up. But to the extent that there's a market, there's functioning market as we have today, with a lot of supply. Because 2 years ago, if you wanted to buy $5 million, it would be a question of, you have to join the queue, you get filled in bits. Today, if you wanted to buy $5 million and you gave your order to your bank, it will be done that same day. In fact, maybe in a few hours. Because the demand is there. It's only when you say, I want to buy at a specific level, that's when perhaps you have to be on the queue. But if you want to buy at markets, there's FX liquidity available.
All right, Dr. Bamfo, I want to talk about the yields. So for the first time, I think in a very long time, we saw that our inflation at 24. Yesterday, there was an auction. We saw a reduction in yields. Last year, yields were just flying. So all of these numbers with possibly what the decision that the MPC would do, what does it do to our fixed income, our money markets?
So I'll look at it from a monetary point of view. He's the finance guy. Tell you more about yields. But I think what is going to be important is this, at the end of the day, if you have the monetary policy rate either holding or decreasing, right, it's going to have impact on other interest rates, which includes some of these yields that you're talking about, because it's the benchmark for all the other interest rates. And that's the reason why, Hakim keeps stressing about the advantage of having high yields, right, or high interest rates. Then portfolio investors are happy, Yes, but on the flip side, when you have higher interest rates, on the real economy, cost of borrowing for investment purposes is also too high, and business people are not happy. So you, as a manager of the economy, have to look at the balance. You understand me? If I'm in the real economy and I'm a business owner, I'm looking at the interest rates coming down. You understand me? I'm not thinking about yields on fixed income bonds and all that. If I'm a portfolio investor, that's what matters to me. You understand me? So it's that particular balance. So holding now might be safe for both parties, right? It allows us to all figure out and say, okay, this was due to a rebase, right? Let's hold and let's see how we can actually tackle issues, right? So that would be a safe position to take. But if they have intel and they believe strongly that they can actually, manage this inflation and have a further, downward trend, then they can be bold enough and say, we are more concerned about the real economy. We've actually punished them for almost a whole year. Cost of borrowing, a lot of SMEs can't get access to funds in order to start their business or expand, right? That has become our second priority after price stabilization, and we think we can achieve a downward trend. Then in that case, there might be some incentive to reduce the benchmark interest rate, and that can have that unintended adverse effect where those portfolio investors are going, this is the downward trend. Let me cash in now.
And I think that's what Mr. Hakim is afraid of. He's been talking about it.
He's a finance guy.
The FPIs might just run away.
Yeah, exactly.
Can't we do it without them?
Well, at the point the central bank started to attract, we've always attracted, FPIs. But the thing with FDI which is the one that is more sticky, more stable, is that it takes a while. Yeah. When the president was just inaugurated, he went on road shows all over the world, and he's having those conversations, etc. Now, I'm not even sure whether we've started seeing the benefit of all of those. It takes a while. But we were in a precarious situation at that point in time where, there was no access, illiquidity in the FX market, and people who needed to do their business were struggling. Small-scale manufacturers who needed to import were struggling to find FX to be able to buy, whatever it is, the inputs into their process. So at the time the central bank went on a deliberate move to attract FPIs, it was important, it was necessary. Because if they didn't do that, the journey would have been longer. Now, I agree, and I think that's the point you're trying to make, that, these guys are just here, for the yields and all. But the truth is, this FX that they brought into the markets has helped us to stabilize the system, right? Maybe the currency would have been, I don't know, because the central bank, for a long time, was the one supplying dollars into the markets, and reserves were under tremendous pressure. Mm-hmm. And if you compare that, and at that same time, there were also issues with oil production in the Niger Delta. Mm-hmm. Now, the government has found a way to solve all of that, and that's why we're seeing productions at almost 1.6 million barrels, and all of that. But we need to time it and time it properly. That's what I would say, because while I agree that these guys are just here for the yield, and when they're ready to go, they go and they create issues for you. But I think we still should not discount, the stability those flows bring into the market. FDIs, yes, we're going to get it, but those will typically take time. Okay. And that, for me, is how we should run this.
We're not patient enough. All right, I'm sure you saw a bit of the screen there. We can see that the seats are filling up at the CBN headquarters, and we do expect once the Governor Cardoso comes out, he would start that announcement. But let's take a short break, perhaps to have a breather for our guest here, and also get more details of what's going on at the CBN headquarters. But we do know that it's supposed to be 2 p.m. and Governor Cardoso does keep the time. Let's take a short break. We'll be back with most likely the decision.
That's one. If this is already happening, I think it's a very right step in the right direction, because if you noticed, over the last couple of CBN governors, every time they came on here to give this kind of statement that I just made now, there's always, we've done this, we're hoping the fiscal authorities are going to do that. Because the central bank, remember, they look at the total economy, right? And the tools that they have are quite limited. At some point, that's why under the last administration, you saw CBN dabble into interventionist sort of program. He said he's not going to do that anymore. Therefore, it needs the other side to focus on areas like that ensures that some of the things that they're doing properly feeds through the system. Because again, it's one thing to come here, cut the rates, but that thing needs to feed through. So right now, we're having, should I say, food issues, food production issues. So what is the fiscal side doing to ensure that maybe the right inputs get to the farmers, to ensure that there's security in those areas, and that the farmers are able to go to farm, and so that those products will come right into the market and people can get food at affordable prices. So, for example, we've had these long issues of how to move goods from farm to the market, onto to our kitchens, right? Those issues have been there, and those are not things for the central bank to handle. They're a monetary authority. So the fiscal guys are the ones that need to then work on some of those details to ensure that we are not just only relying on road transportation, that we also start to build in railways and all, that ensures that food products are moved from parts where they are being produced right to the areas where they are being consumed. So those things are what I believe they need to do, going forward. And it's not something that is for the central bank to do. They need the fiscal authorities to also come to the party.
All right, Dr. Bam, for parting words, now what do you see by this May 19th and 20th? What do you see by then?
Once again, I'm excited. It's been a while since I've listened to an MPC meeting and left, excited about the potential opportunities that can come out of it. So what do I see? I'm hoping that the investments that they've made in transforming the foreign exchange market continues. We have a very transparent, a very efficient, a highly credible foreign exchange market. I want him to not only focus on the fact that they've bridged the gap between power market rate and the official market rate, but more importantly, about the appreciation of the Naira. I think it should be something that he should be confident in saying that, look, we're on track of maintaining that appreciated value, because it has implications for the goods and services market. You understand me? So if we continue to have the Naira appreciating within some reasonable band, you understand me? It's always going to be volatile, but it does have to be like that. It has to be, in a downward trend. If we're able to do that, then what happens is that we can have, investors being confident, reinvesting in our country, domestically, foreign direct investment. We have new businesses springing up. Interest rate gradually starts coming down. Cost of borrowing is cheaper. Then, all the resilience that the business sector has, mastered during the tough times, they can now release it for real growth, because we're just fighting against headwinds. You understand me? Now, if those headwinds become tailwinds, then we really take off. So really, that's my excitement, and I hope that by the time we meet again in May, we'll see trends that are encouraging and exciting for the nation as a whole.
All right, you started with the excitement and going home with the excitement. How lucky are you, Dr. Josh Bamfo, partner and head of Transfer Pricing Services Practice at Anderson, Nigeria. Thank you so much for your time. Mr. Kim Mohammed, Executive Director, Global Markets and Institutional Banking, FSDH. Thank you so much for your time and your views.
Thanks for having us.
Thank you.
All right, so it's a hold for Nigeria. That's what it is. Excited panels that we had all through all of that. Of course, in the coming days, we'll have more views and perspective to this position of the MPC for February. So I guess this studio will be closed until May 20th, when we'll be back again. But obviously, Business Morning and Business Incorporated will dissect all parts of this in the coming days. I'm Ini John Mekwa. Thank you so much for being a part of this.